Greg, you've been concerned for a while about the markets. You think that we've actually seen the high levels for markets for this year, and you're concerned about the Fed. You want to lay out what you're thinking here?
Yeah, more specifically, my concern is that the Fed seems to be pointed down one road and the market seems to be pricing in a different scenario. I think that's still the case. That was my position for the first few months of this year while we rallied. At the end of the day, the 450 basis points we've seen from the Fed at this juncture has not affected unemployment in the ways that they have wanted. Remember, the Fed's position is that services inflation is our most poignant danger at this point, and that wage growth is what spurs services inflation. The Fed has postulated a 4.5% unemployment rate is what we need to curtail services inflation. And who knows, maybe it's 4.3, maybe it's 4.2, but it's certainly not 3.4%, a lower unemployment rate than what was the case when we began this hiking cycle. And so I think what you saw with the Fed coming out very hawkishly in the last couple of weeks is they've noticed the disconnect. And they're trying to prod the market to close that disconnect of what the market is discounting, which is probably 75 basis points from here, to what the Fed will likely have to do, which is probably more like 100 to 150 basis points from here.
But you think we've seen the high watermark for stocks this year? I mean, I think that's probably the most surprising takeaway.
I do. And until the market and until consensus starts to come around to what I think the Fed's view is and what, quite frankly, my view is, I think that these market levels are inflated. I think that the equity indices are too high. I think that yields are still too low. If what the reality is that we have another 150 basis points to go before we hit the terminal rate. What that also means is that estimates are too high. And, you know, we saw this phenomenon in every quarter last year where the estimates would come down dramatically in quarter, and it still wasn't enough. Even the fourth quarter, we started at mid-single digits. When the quarter ended, we had negative 3%. Quarter's going to end around negative 5%. And so maybe the first two quarters where consensus is single-digit negative are in line, but we're looking at double-digit growth in the back quarter, and that's probably wrong if the Fed has another 150 basis points. So we have the market reconciling what true estimates are going to be in those downward revisions, which we know are a headwind. And we also have the market reconciling a higher terminal rate than it's currently discounting. I think that those two things will take the market down as investors come to digest that.
Hey, Cameron, I know you're concerned about stocks, too, but I think you come at it from a slightly different position. You're worried about margins. So you're kind of worried about the inflation picture still impacting companies, too.
Well, we think that as inflation moderates, that could actually be the driver of falling margins for S&P 500 earnings, because it slows revenue growth when you have less inflation, you have less pricing power. And so we think that there's a chance that margins essentially correct back to their pre-pandemic levels. And we started to see this dynamic in the fourth quarter of earnings, where we saw revenues still growing about 4%, but earnings fell 5%, all because of about 100 basis points of margin compression. So we think as we move through 23, we could be in a scenario where we may not have an economic recession, where we still are seeing revenue growth, but we could effectively have an earnings recession simply because of that margin dynamic, which means that we still have this constant march lower in earnings estimates.